The wildfire that raged across 58,000 acres in California, consuming everything in its path, has left behind a trail of devastation that is almost impossible to fathom. However, as if the physical and emotional toll were not enough, California homeowners are now grappling with a second, equally harrowing crisis. Insurance companies refusing to honor their claims.
It's a lot of hard work building a business, and seeing this, it's tough.
In the aftermath of the fire, countless residents turned to their insurance providers, seeking compensation for their immense losses. These claims were not just financial lifelines. They represented hope for rebuilding lives and communities. Yet, as reports indicate, many insurance companies have begun to reject these claims, leaving thousands of homeowners in Los Angeles without a way to recover. This refusal has sparked outrage and legal battles, as homeowners struggle against an industry that appears unwilling to support them in their darkest hour. The situation has become so dire that even the intervention of the California state government has provided little relief. In an effort to prevent further hardship, the state issued an order prohibiting insurance companies from canceling policies for affected homeowners in Los Angeles for a year. However, many residents report that this mandate has done little to improve their circumstances, as insurers continue to delay, deny, or outright refuse their claims. This crisis exposes a troubling reality. When disaster strikes, those who need support the most are often left to fend for themselves. The wildfire may have been an uncontrollable natural disaster, but the failure of insurance companies to step up in its wake is a man-made catastrophe. If immediate action is not taken, through stricter enforcement of consumer protection laws, legal consequences for non-compliant insurers, and perhaps even a state-backed relief program, thousands of Californians will remain homeless, financially ruined, and betrayed by the very institutions meant to safeguard them in times of crisis. The rising frequency of natural disasters in California has created an insurance crisis that is pushing homeowners to the brink. Beyond the tragic destruction caused by wildfires, the financial aftermath is leaving thousands of residents struggling to afford home insurance, or even secure coverage at all. Since 2019, over 100,000 Californians have lost their insurance policies as major companies like State Farm and Allstate have pulled out of the state's high-risk areas. State Farm alone recently canceled 72,000 policies, including 30,000 for homes. The situation is dire, and its effects are spreading beyond state lines. The double tragedy of California homeowners. Wildfires tore over 28,000 structures in the Los Angeles area. Homes, businesses, and schools. Nothing was spared. At least 27 lives were lost, and the destruction left behind is immeasurable. The financial toll is staggering, with estimated damages and economic losses reaching $375 billion. Insurance companies are bracing for impact, with preliminary loss estimates ranging from $50 to $70 billion, making this the largest fire-related catastrophe in history. The numbers are almost unfathomable, and yet, for those of us who lived through it, the pain is beyond statistics. Some say the insurance industry is a canary in the coal mine for the climate crisis. If that's true, then the canary is barely alive. The California homeowners insurance market has been thrown into disarray. Since 2022, 7 of the top 12 insurers in the state have stopped renewing or writing policies in high-risk areas. Some insurers have abandoned the state entirely. It's not just California that faces these severe climate threats. Nearly 44% of U.S. homes sit in areas vulnerable to extreme risks like flooding, wildfires, heat waves, and wind damage. The question looms: do insurance companies have the reserves to cover this disaster? And if they do, what will the cost be for homeowners who want to protect their properties in the future? Joan Zoloff believes that rebuilding will take years, and the cleanup alone will take months. But beyond the debris and destruction, she has deeper worries. Once they manage to reconstruct their homes and lives, she questions whether they will even be able to find insurance. Every night, she wakes up at 2:30 in the morning, haunted by these questions. The fire has taken more than just their homes. It has taken their sense of security, their confidence in the future. She wonders, what happens now? Can insurance afford disaster? Joan Zolotha's story is one of devastation and frustration, a stark illustration of the growing crisis in the insurance industry as natural disasters intensify. Living in the Rambla Vista section of Malibu, her family owned 3 homes, her beach house, her parents' home, and her son's home. In a cruel twist of fate, all 3 were reduced to ashes in a recent wildfire. The loss was not just financial, but deeply personal. Her son, having lost everything, was left in shock. However, beyond the tragedy of their individual loss lies a larger, more alarming question. Can the insurance industry sustain itself in the face of escalating natural disasters? Zolotha's situation underscores a disturbing trend. She applied for homeowners insurance with USAA, a company that historically served military members and their families. Yet, despite her family's long history with the insurer, her application was flatly denied without explanation. The rejection left her devastated, particularly given her parents' decades-long loyalty to the company. But her case is far from unique. Homeowners in California have been facing an increasingly hostile insurance market, with fewer options available as companies retreat from high-risk areas. The exodus of insurers from California is a symptom of a larger problem. State Farm, the state's largest insurer, stopped issuing new property insurance policies in 2023, citing rising construction costs and wildfire risks. In a further blow, 9 months later, it dropped coverage for 72,000 homes and apartments, blaming financial instability, inflation, regulations, and disaster exposure. The numbers paint a bleak picture. State Farm's California surplus, which stood at $4 billion in 2016, plummeted to just $1.3 billion by 2023. This steep decline exemplifies how insurers are hemorrhaging money in high-risk states, making it clear that the traditional insurance model is under immense strain. California is home to nearly 39 million people, more than half of whom own property. The increasing frequency and severity of wildfires have driven insurance payouts to unsustainable levels. For every dollar in homeowners insurance premiums collected over the past decade, the industry has paid out $1.17 in claims. This imbalance is simply unworkable. Insurance companies are not infinite wells of money. They depend on a delicate balance between collected premiums and paid-out claims. When that balance is disrupted, the entire system begins to collapse. But this crisis is not confined to California. Florida, Louisiana, and Texas have also seen insurers pulling back due to worsening hurricanes, floods, and wildfires. The intensifying climate crisis means that more people and businesses are being pushed into harm's way, and insurers are struggling to keep up. As wildfires grow more extreme, the financial burden of covering destroyed homes and properties becomes unmanageable. State Farm has insisted that it remains committed to serving its customers and is working with California to develop a sustainable insurance market. However, the reality is that the industry is at a breaking point. If insurers cannot find a viable way to balance risk and affordability, more homeowners will be left without coverage, forced to bear the burden of disaster alone. The question remains, in a world of escalating climate catastrophes, can insurance companies survive, or will homeowners be left to face the storm alone? California's insurance crisis, a perfect storm of regulation and rising costs. California is facing a growing insurance crisis as a combination of regulatory hurdles, rising costs, and increasing natural disasters put enormous pressure on insurers and homeowners alike. The state's unique regulatory framework, particularly Proposition 103, has played a significant role in suppressing insurance rates, making it difficult for insurers to set premiums that accurately reflect the risks they face. Proposition 103, passed in 1988, required the state's Department of Insurance to approve property insurance rates and mandated a 20% rollback in rates. While this was intended to protect consumers, it has had long-term consequences. Until recently, insurers in California were also restricted from using modern risk modeling when determining their rates. This meant they lacked access to the latest data on wildfire risks and other natural disasters, limiting their ability to make informed decisions about their risk appetite. At the same time, the costs associated with rebuilding after disasters have skyrocketed. Over the last 5 years, the cost of construction services, including labor, has increased by 35.1%, while construction materials have risen by 37.3%. These rising expenses make it even more difficult for insurers to offer coverage at sustainable rates. As a result, many homeowners have been forced to rely on California's insurer of last resort, the FAIR Plan. This insurance pool, which all licensed property insurers in the state contribute to, is designed to provide coverage for those who cannot obtain policies from private insurers, particularly in wildfire-prone areas. Between 2023 and 2024, the FAIR Plan saw a 40% increase in policies statewide, with some areas, such as the Pacific Palisades, experiencing an 85% surge. However, the FAIR Plan itself is facing a financial crisis. The plan could be responsible for as much as $8 billion in losses from recent wildfires, yet as of January 10th, it only had $377 million in available funds and $5.78 billion in reinsurance. Reinsurance, essentially insurance for insurers, helps cover large-scale disasters, but if the FAIR Plan runs out of money, insurers operating in California could be forced to contribute an additional $1 billion to cover claims. Given the scale of recent disasters, it seems likely that the FAIR Plan will be overwhelmed, triggering further financial burdens on the insurance industry. For homeowners, the consequences of this crisis are severe. The FAIR Plan caps residential payments at $3 million, meaning many homeowners, particularly in high-income areas, could find themselves underinsured. This issue of underinsurance is a recurring problem after every major natural disaster, leaving many residents struggling to rebuild their homes and lives. A growing threat to homeowners. Insurance companies are faced with a tough choice: either withdraw from high-risk markets or significantly raise premiums. With billions in payouts year after year, many have opted to exit California altogether. Homeowners who lose their private insurance policies often have no choice but to turn to the California FAIR Plan, a last-resort insurance option specifically designed for high-risk properties. However, this plan is far from ideal. Its premiums are often double those of standard insurance policies, and the coverage it offers is limited. Many homeowners find themselves without liability protection or receiving only partial compensation for rebuilding costs, leaving them financially vulnerable even if they are technically insured. The crisis is exacerbated by California's strict environmental and housing regulations, which prevent homeowners from rebuilding their properties as they once were. These evolving restrictions make reconstruction more expensive and time-consuming, discouraging homeowners from staying in disaster-prone areas. As a result, many families are choosing to leave California altogether. This mass exodus has significant economic repercussions. With wealthier homeowners departing, property tax revenues decline, leading to budget cuts for schools, infrastructure, and public services. The insurance market becomes even more strained, creating a vicious cycle of financial instability for cities and homeowners alike. Analysts predict that insurance costs in California could rise by as much as 40% on average. This issue is not limited to the Golden State. Other regions, including Florida, Texas, and Colorado, are experiencing similar trends. Insurance companies are preemptively increasing premiums nationwide to offset potential future losses, making homeownership more expensive across the country. If insurance rates continue to soar or policies get canceled, this growing crisis may serve as a warning sign for the entire nation. In response, homeowners can take proactive steps to mitigate risk and potentially lower their premiums. Simple measures such as creating fire-resistant landscaping, using non-flammable building materials, and installing ember-resistant vents can make a difference. However, There is only so much individuals can do against the sheer force of nature. As the California insurance crisis unfolds, it highlights the urgent need for national discussions on regulatory reforms and rebuilding policies. Without addressing these issues, more homeowners will find themselves in precarious financial situations, and the stability of entire communities will be at risk. Whether you currently own a home or are considering moving to a high-risk area, evaluating insurance options early is crucial to avoiding unexpected hardships in the face of disaster.